A warm welcome to all of you at CIEL. We've got some people online, so welcome to all those who are online. It's Friday afternoon, so we'll try and be as down to the point as we can, and also, but that doesn't prevent you, of course, from asking all the questions. We are there to diligently answer them. So if you want to ask a question for those who are online, please use the Q&A session, and if you can mute yourself so that we don't have interference. So we are and today alongside me is Jérôme de Châteauneuf, Guillaume Dallet, who you all so I'll just give you a quick highlights on the results before passing on to Jérôme. Just to say that, well, I think it's the first slide. Yes. So we had, I mean, the turnover hasn't grown. In fact, it's reduced slightly, basically due to a textile slowdown, and we'll come back to that. But very good EBITDA growth at the level of 27%, leading to an earnings per share that grew by 28%, and free cash flow at 1.8 billion. So very healthy results on the back of a turnover which is steady. A good chunk of it driven by the hotels and resorts that have done particularly well, with an increased average room rate despite a slightly lower occupancy, and we'll come back to that. Textile, as I mentioned, has been a bit more difficult, but we still think that the momentum is good, and I'll point out to you later on where are some of the challenges. Find more about it. And on the healthcare, we had a very good performance of Uganda, and that augurs well for our developments in Africa. And Mauritius has also had a good performance given the circumstances and the previous impact of COVID on last year's figures. And Guillaume will cover the healthcare and the properties side, which has had also a very good year with lots of developments and a good exit of land. And Jérôme will cover the agro turnaround of a business in Kenya and improved performance also in Mauritius. So EBITDA for 6 months at 4.1 billion. This is the highest we've ever been, which is in fact leading to a very low projected debt to EBITDA. Good profit at 2.7 billion, and earnings per share mentioned. Margin very healthy, so we had improved already quite significantly last year to close to 18%. Now we are close. So that was a quick highlights of the performance, and I pass on to Jérôme for the facts more detailing.
Good afternoon to everyone. So I'll go through the key financials for your attention. So we've got the first slide, the turnover, as Jean-Pierre mentioned, we're quite flat for the 6 months, around 17.8 billion rupees. The shortfall in the textile, which Jean-Pierre will come back later on, has been somehow mitigated by good performance from the healthcare, finance, which Lakshman will cover, and the hotel and resorts cluster. We've given you the bar chart with the last 3 years of results of turnover, and you can see that well, the textile is still the main contributor to the revenue of the group. About 50% of the revenue of a group accounts for the textile segment of CIEL. Now on the second slide, you've got 2 pie charts. The one on the left is a pie chart which gives us where we generate. The pie chart on the right gives the revenue mix of our revenue base. So what we can see, the inner circle showing the prior year figure on the left and the outer circle, the last 6 months. We can see that we've been pretty consistent in Asia with 22% of the revenue generated there, mainly textile. As regard to the Mauritian section, we have increased our revenue from Mauritius from 40 to 45, but it's mainly led by reduction of our textile activities. What we call Africa is in Madagascar. So because of a shortfall in order, we've reduced our production capacity, and this has impacted the pro rata share of Africa versus Mauritius. In terms of revenue mix, we can see that the main contributor is the euro, which accounts for 20% of our, sorry, the dollar, US dollar, for around 30%, the euro 20%, and GBP 5%. So we've got 55 to 60 resource today, as we know in Mauritius context. And we've got 15% on the rupee, and what we call others is a mix of South African a substantial proportion of what we produce in India. The next slide, the EBITDA waterfall, shows what Jean-Pierre expressed before. We were at an EBITDA margin of 17.8 for the six months to December 2023. We're now at 22.9. With most of the clusters improving their performance in terms of EBITDA generation over the period, except the textile sector, which is down by 182 million. But we can see that the finance cluster for 390, especially the property, and Guillaume will come back to it, where we had our plan of selling land. We've been able to realize a major sale of land, which has therefore helped in the generation of EBITDA of our property. So we've reached the 4 billion mark for the 6-month period, which is quite an achievement compared to some years ago, where we were struggling during the COVID years. This pie chart shows the country. So the profit after tax, which amounts to 2.7 billion for the 6 months, up from 2 billion. And the main contributor today is the hotel and resort sector, mainly Sun, which accounts for a third, followed by finance cluster, which has had a strong performance during the first semester of the year, and subsequently coming very close, the property, the textile and agro performance also, which has been a very good in this semester. Got our pro rata share of RTO and MIWA's results amounts to 308 million compared to 185. And the healthcare at 160 million accounts for 6% of our revenue. So as mentioned, in the last 3 years, we can see the growth for the first 3 months, where we jumped therefore from 2 billion to 2.7 billion, 37% growth in PAT. And this is equivalent as regard to profit attributable to a 28% growth for the first 6 months attributable to our ordinary shareholders. Free cash flow, we attach a lot whereby it shows that we have generated 1.8 billion compared to 1.5 billion. And each column is subdivided into 3 columns: what we generate from our operations, how much we eat into working capital requirement, and how much we spend into CapEx. So we can see that we've generated 3.1 billion compared to 2.8 last year. We've improved in terms of capital requirement needs, lower than last year in terms of, well, in terms of requirement. CapEx also higher than last year, maintenance CapEx. So basically, the ability to generate cash comes mainly from, among others, from the hotel cluster. And we'll see the gearing later on, but the gearing of not only Sun Group, but also CIEL has gone down. So here we are, financial discipline within the group, gearing, which is lower than 30%, which has gone down over the years. and therefore gives us the firepower to invest into new ventures. We're going to come later on in the presentation here with tell you about be able to be maybe more active in some of our investment. And a debt to EBITDA, which is down to 1.4. Portfolio, the pie chart on the right shows that we are at a portfolio value of 23.8 billion, a growth in the portfolio of around 12% from June position, an increase of the NAV per share to 12.48, which is a 13% increase, and mostly from all of the segment of our portfolio, an increase over the period. All those quoted or listed companies, the stock exchange having performed well during the 6 months, we benefited from an increase in the underlying share price. The finance cluster, which is mark to market through multiples, be it price to book or price earning, we've also benefited from better performance from Bank One and BNI, which has helped boosting the valuation. The only one which hasn't moved is the Texas, but we do this exercise only once a year. Well, for the June cutoff. In terms now of share price movement of CIEL, 620 in January, which is on the base of a calendar year. We were around 620 at the beginning of the calendar year, and we ended up at 688. We currently are hovering around the 7 rupees. With the release of the results, I think today we've gone up to 7.08 rupees, and we've therefore beaten the performance of the Sendex. So that's the key highlights of those 6 months. Now we proceed to an overview of each of the clusters, the 6 clusters of the group, and the presentation will be shared among the 4 of us. So I'll start right away with the agro cluster. So the agro cluster, just to remind you, we own just short of 21% of Miwa and Alteo, and there has been a marked improvement in the performance of both those entities. And our share, therefore, has increased from 187 for the first 6 months of last year to 308 million for the year. And we can see that not only on Miwa side, but also on Alteo, the profits have a substantial improvement. Just to say, first of all, that the sugar industry is quite cyclical, and we are, for the first 6 months of the financial year, going through the harvest season in Mauritius. So this is the period where we generate normally most of our revenue from the sugar cane. But we had a very good harvest, an improvement in the yields, which led to an increase in production of around 10% in terms of sugar tonnage, and at a much higher price. So the sugar price is probably never been so high. We're selling the ton of sugar at 27,000 rupees. And this is helping a lot the Alteo cluster to generate cash. In terms of residential project, we've gone through the 6 months into a bit of a slump because there hasn't been any sales, no major parcels coming onto the market. But overall, through the sugar cluster within Alteo, we did very well, and it's showing in the results of Alteo. Now on Africa, on East Africa, through Miwa, we have had has generated as much profit as Tanzania. If you've seen the Miwa results, they've generated $17 million for the first 6 months, which is a major turnaround. So good sustainable production level, very high price, which is helping in terms of the results of Miwa. At TPC, we have some challenge currently. We have had, with the El Nino impact, heavy rains, which unfortunately impacted on the production, especially in coming to the mid-November to December. We have had some issue at the factory with a turbo alternator which broke down. So we're getting some challenges in Tanzania in terms of production this year, but sugarcane is there, the price is sustainable and it's been above $800 for the period. So though we don't expect, and certainly we're not going to generate twice this bottom line for the first 6 months, but it's been an exceptional performance over the first semester of the financial year. So what's next for RTO? Whereby the first phases have been launched. It's a green sustainable project. And on the agro side, it's mainly continue to bring down, to control the costs, because we're going through a period where the price is good, margins are high, and we need to use it to bring down the indebtedness and make sure that days to come will become more efficient and preserve the profitability of RTO as a group. And in terms of MIWA, the challenges is really try to optimize the byproduct of a sugarcane. We have a project based on molasses for a distillery in Tanzania. And as regard to Kenya, we are also considering from the bagasse, which we today produce electricity and sell it to the grid. We are considering a project, a major project down the line. So that's the key messages from the agro cluster. I will now pass on back up into Jean-Pierre, who's going to cover the hotel and resorts. We'll take
hotels and resorts. We had an excellent first 6 months of the financial year with Sun Life brand. The revenue increased by 10%, but leading of a nice flow through to EBITDA improving by 19% and profit by 37%. So there was a slight decrease in the occupancy, but the ADR grew very well and led to a 15% growth in RevPAR, which is pretty excellent. I must say that at Sun, particularly so at Sun Life, cost management has been very good, and overall, I mean, the financial performance with cash level at 1.5 billion, leading to a net debt excluding MIC, which is quasi equity, of 3.1 billion, which is giving us a ratio of below 20% in terms of gearing. So excellent first 6 months, and I must say that looking forward, we're seeing that the bookings for the first quarter is pretty encouraging, but it's a bit early to confirm that. We'll see as we move forward, as there is more and more late-minute booking. And but the challenge we constantly face, I would say, is to make sure that we grow the customer experience within our hotels. But there's a big plan on that to make sure all the processes are improved, and a lot of work on the employees to make sure that the team works well in tackling the experience of the customers. What we also want to do is to fast-track the property project, for instance, the La Pirogue residence, which we hope to launch in a very near future. Maybe Guillaume will be able to say a word about that later on. And also working on a number of other property projects within Sun that could drive more revenues. Where it's been a bit more challenging has been on the Four Seasons, where we had good results, but we think that there is an opportunity to do much better than that. And the Shangri-La Le Tourist has where the property team is working strongly, and that can be also a significant value creator for the group. Now, moving into CIEL Textile, which, as I said, has a much more difficult first half. I think there's been a And quite clearly a slowdown in the retail market, but has affected our orders. There's been a lot of stock, post-COVID, there was inventory buildup, and this has put a bit of a reduction on our orders because they've been significantly down, especially so in the US, but also in terms of retail sales, but also about 15% down in Europe. So that was a big impact that led to our orders falling. We see that the woven sector, so essentially the shirt making, particularly so in India, has kept on doing very well with healthy margins. So we are well positioned as one of the top class shirt manufacturers in India. Is good in India, but the situation in the region is more challenging as we are a bit off, the central procurement line of main retailers, but nonetheless generating a good pipeline. The knitwear segment has done very well, and we keep on doing well. It's a niche player on the wool market. And developing its sales in the US as well as Europe. Where it's been more difficult has been on the knits cluster, which had a difficult year. I mean, there was a lot of buildup during the COVID, in fact, of inventory, and that came quite drastically down. And we were working a lot with one customer, ASOS, which had some difficulties. So that was really a big impact on our order book. So we are busy right-sizing the business, reorganizing it, expanding the production in Madagascar, and also looking at how we can tackle India for it, because we believe that fine knits can be a big growth story for us in India, where we already have one factory. What is important to note is that our retailers, which are volume business, for instance, Polo Ralph Lauren or Hugo Boss have become one of our largest customers, and Lacoste is also a big customers who are very loyal and long-term, and which are moving out of China. So we're capitalizing on that, especially so in India, but also in the region. We are, as I mentioned, one of the top 3 high-quality woven shirt operator in India. In fact, we are probably one of the largest foreign textile-owned operations in India. And we are going to showcase ourselves at the Bharat Textile Show, where Modi will also be present. So we are taken as an example of foreign investment being successful in India, and which is something we very much have at heart. We'll continue to capture opportunities, so we're looking for further growth opportunities in that part of the world. And in Mauritius and Madagascar, we will consolidate our position so that we can really boost the competitiveness of Madagascar, knowing that Mauritius, the costs have gone up significantly. And that's a major challenge in all fronts, actually, in all the clusters of the CIEL Group, which we need to be managed very closely. And finally, a strong push on ESG and on traceability. Proof where the scope 3 comes from. So that's it for textile, and I'll move on to healthcare with Guillaume, if you can.
Good afternoon. So on the healthcare side, so I would say a very solid performance driven by operational excellence. The revenue is up, EBITDA is up by 11%. PAT is down, so we've done quite a lot of investment. We had a big capex plan of about 1.5 billion rupees. So therefore, there's higher depreciation, higher finance cost. But this is planned to yield in the future. We opened the cancer center. We're opening cancer center now at Darnay. We opened CIEL in the north a few months ago, which is picking up very nicely. We are very happy about that. We just reopened Tamara, and we have also invested in a number of equipments and in Madagascar as well. CIEL Uganda is doing very well, so the turnaround is very positive. You may not know, but we have rebranded all our clinics in Uganda. We have about 22 clinics. we have branded everything CIEL, so very good visibility on the market in Uganda, and we are positioning ourselves as a leader in this country. So that's very promising for our Africa strategy and how we can build on that. What was important for us is to get the model right, and we have the model right now. Very healthy EBITDA with good growth. So we know that we have a model which we can build on. And then we did an acquisition of CTB in Madagascar, which is more of a medical laboratory type of facility. It's not a heavy capex, very light. It's to enter the market and be able to service the market, especially that we have many patients coming from Madagascar to Mauritius. So as regard to the focus, I think that having the leading position in Mauritius, and obviously we can do better in Mauritius, and we have invested quite heavily. We want to maintain that position and be focused on operational excellence and customer satisfaction. We're very happy, as I said, with Uganda, and we feel that we have an opportunity to leverage on substance. Investment in Africa is either non-profit organization or private equity, sometimes with a lack of substance in that field. So we feel that there's a good opportunity for us to build over time in East Africa. So we are actively focusing on that. We have a team on it, and we are also working with strategic consultants to make sure that our entry to go-to-market strategy is the right one. So we are also upgrading our facilities in Mauritius and Uganda. So I would say that the plan is completed or almost completed. So that's been quite a lot of investment on the teams because it's been a lot of projects, and projects take away time from operations. And we feel that now we are able to refocus really on operational excellence, and the upgrade is coming to an end. And then the CIEL, as you know, is doing very well, and we have expanded our footprint in Mauritius, but also now Madagascar, and actually it's doing extremely well in Uganda as well, because it's coupled with our clinics. Strategic cluster, obviously, for CIEL. We have a great perspective ahead, despite competition. So now on the property side, so revenue is increasing slightly from an operational perspective, but as you know, properties, it's all about unlocking value from the land that we have. So we've started to materialize this strategy. You know that we've got the Smart City certificate on Ferney. So building on that, we have been able to do a major bulk sale, where we have booked about 400 million rupees of profits, or 360 million rupees of profits. And this is really enabling us. The cash will materialize now over 2 years because there's deferred payment in the deal, but it's enabling us to unlock a lot of cash, which is giving us also the firepower to go further in the development of Ferney. So that's the main impact on the PAT. Just maybe one note is that Evolis is doing well according to plan, and we have raised 640 million rupees of notes that we just raised for bonds, and this was successful. So the step for us is really we are launching future phases in Evolis, so being Nuvalusin and Flexeo, so to optimize the yield. This is going well. Phase 2 of Nuvalusin that we launched, we already have occupancies of 97%, so it's already booked and will be delivered in March. And now the real focus for us is to deliver the farm living project, where we're waiting for the EIA to start construction in March, April, and delivery before the year and before the June 25. So it's high sold, so it's a high cash generator for us, but high profit generator as well, which we are targeting to book in the next financial year. Because it's been sold now, it's a question of building infrastructure and delivering to clients. So that's on Ferney, the strategy maybe a word on Sun. So we are working on all the projects. As you know, there's a lot of assets which has not been unlocked. So La Pirogue, we've reached 26 CRP. So we are planning to launch the project in May of this year. So we are finalizing this. So we're working on new projects across the board for some. So that's and I'll hand over to Lakshman. I can take a question later.
Good afternoon, everybody. So for finance, a good set of results as well for the first 6 months, more or less trending the first quarter. So revenue is up 12%, EBITDA 59%, profit after tax 48%. Led primarily by the banks, BNI leading the show, followed by Bank One, but also a good turnaround from Midco as compared to the first 6 months of last year. See just now. So that's broadly on the top level. Let's look at where our focus is. We are looking for further investment opportunities, primarily in technology. This is where we believe our future will lie, especially as it moves very, very fast in the financial services sector, and as we can see all across the world. We are deepening our data and digital investments in both banks. And finally, we are a taker of the client franchise, so we need to be very alert to the needs of the clients, solutions where we can, and just make sure that the offerings that we have for our client franchise is relevant to the client. Not the other way around, good products, but not necessarily sure whether the product will have a taker. During in retail, it's the way that it goes, but we are looking to be more alert to the client needs. And to support, especially the digital technological side, I have the pleasure just to share with you today that I have appointed a Chief Technology Officer at CIEL Finance to look at the investment side, also at the potential of embedding new technologies. So we have Mahen Govinda, who has taken up the role at CIEL Finance to support me and the broader portfolio in that direction. So I've just mentioned that bank have led the momentum of this performance for the first 6 months, and more specifically BNI. They've just closed their financial year. They had a very strong finish in the last 6 months, which of course has benefited by in Madagascar, from a network perspective. Bank One, very selective, Africa focused, and of the services it wants to deliver, primarily looking at the cross-border investment trading, special licenses, and looking to be very, very focused in terms of where it wants to head in the next 2 years. From an investment perspective, as has been mentioned earlier on, the valuation is up. Bank One, a 24% increase in valuation, primarily led by the price to book benchmarks for the portfolio or the benchmarks that we have. BNI, 32% increase in value, led by its profitability primarily, but also its forecast. It uses a discounted cash flow method, so the prospect being very, very good, has benefited the valuation. And Midco has benefited of a 9% decrease, primarily led by the benchmark on the SEMDEX for financial services. So the price earnings drop and therefore the value drop, but that's against the benchmark for the financial services sector on the SEMDEX Mauritius. Overall, a 23% increase in the valuation of the portfolio. Good outcome, but again, based on the valuation methodologies. I want to focus has brought the most significant performance and maintains the trend from prior years. The bank is a taker of the economy and the population of the target segments in which it operates. It now operates for the domestic market. It's a large population, 24 million, heading to 30 million. Just back from Madagascar yesterday, and as per my conversation, most will be 45 to 50 million people in the next 5 years. So very strong population growth, and the bank So the potential of banking those over time, young population. So maybe a slow start that hopefully accelerates as the economy keeps growing. So that growth in the economy in absolute terms, the gross domestic product, the election being behind us now since November, stability prevailing, and investors back to the market, primarily on the infrastructure side, which hopefully has a multiplier effect on the economic growth and our clients benefiting from that, from individuals to the corporates. Becoming primary from Guyana and Madagascar, at least in the short term. As I said, underbanked. So those are 2021 numbers. We have more recent numbers, but I wanted to have a consistent approach from where we are sourcing our data, from Global Financial Inclusion to the World Bank. The 16% of the population is banked, as banked. A lot happening on the mobile and microfinance, but actual banked population is 16%. Mobile money growing fast, so it's 23%. Very low take-up on payment solutions, be it credit cards or debit cards. And access to internet is very good. And this is where I was saying earlier on, any technological solution being developed, which was apps, connectivity, internet, stands a chance to drive performance and opportunities in Madagascar. So that's where, the client franchise, this is the client franchise, and hopefully we can tap into that potential. The strategy is to BNI has been primarily banking corporates. The tree of the nationalization and the bank being put back with private shareholding has led the corporate segment of the market. So we want to acquire more of the retail segment, and this is being achieved by the growth of our retail network, which now stands at 112 branches as compared to the second bank in terms of network, Bank of Africa, which sits at 80 branches. So we hope that access to banking, growing population will allow us to rebalance a bit of that. What happens there is a better margin. Corporate is, as usual, very competitive, and therefore a better margin on the retail segment and improving our bottom line and, of course, number of clients. Improve our processes and systems, so operational excellence. And then the employee value proposition in order to attract the best talent to support it prints and is a key component of the balance sheet, especially in terms of loans and advances. To grow that retail contribution, I would say enhance our SME offering because we're already there. Our channel and product line does contribute. I think the pace of growth of that segment has been very good as compared to well-established players in that market. We're not playing there before 2019, but the growth trajectory there has been excellent. And then, of course, Madagascar being a very poor country, our ESG relevance, our contribution beyond doing business will be very important. And I must say we are the only bank which is not owned by a banking group as such. All the other banks are leading banking groups coming from outside Morocco or France. So that's the growth story. The portfolio, 400,000 clients, 24 million people, so a lot to do. The distribution, corporate leading the show, as I said, followed by retail, and SME growing fast. For government instruments. So BNI's KPIs for the year ending 31st of December. we are talking in terms of rupees here. So 3.6 billion of net banking income, net profit of 1.4 billion rupees, ROE of 33%, capital adequacy, well capitalized for the immediate growth aspirations, deposit base being maintained, and the loans and advances tracking more or less our plans. Those are high-level numbers. There's more lying behind that. But once the audited accounts of BNR are, you have a bit more segmental information. So from the group, beyond the numbers, this is where we are focusing. People, very important. We need good people to drive our strategy. We employ 1,100 people, thereabout. Inclusive workforce, internal leadership, and digital skills, and promoting great place to work as part of the initiative of the group, CIEL Group. Financial inclusion, critical component of the domestic market, access to finance. So the SMEs part is very important, and that will have a multiplier effect on the economy. We have created and want to support enterprises who have put across viable business models, proven and tested, but not having access to finance. So we run a competition to create awareness, but beyond supporting them financially, we also give them internal expertise, so accounting, management, and etc., to allow them to grow a bit faster. And finally, the impacts on low populations or remote populations. We open branches in areas where nobody has been in Madagascar. So that's the financial inclusion part. Finally, environment, as deforestation is accelerating in Madagascar, a lot of efforts being done there. Right. Reforest the country with endemic trees and species. And on that, we have dedicated one full day in the bank just for planting. I think we can do a couple more, if anything. And finally, the carbon neutrality by 2030 from operational emissions. And that will require more work in terms of how we achieve that. But most certainly, renewables becomes a critical component of that. So that's on the ESG. And that's on BNR as well. Briefly, on Bank One, they maintain the trend. We'll conclude the year at 660 million PAT. ROE at 17%, an improvement from last year. Capital adequacy or efficiency of capital usage. We come off from 20% plus from COVID years to 17. So risk-weighted assets and loans and advances are growing and contributing the capital and generating the right. The strategy there is still to look at the digital component, more so on the cross-border side, where people are looking for ease of and then good liquidity and capital levels for future growth. Growth opportunities still remain centered to sub-Saharan African market. We are focused on financial institutions. We might be looking at a bit more the top end or mid-tier corporates for a bit more risk appetite, and then accelerate the growth portfolio within Mauritius and across the region through our private banking offering, which has, I assess, a good custody offering, which is appealing to our clients in that segment. And finally, Midco, as I said, it turned around from a loss-making position in the first 6 months of last year. We are now profitable, and it is led by chargeability. So we've aligned a bit the costs relative to what we read from clients. So that has been a one driver. Debt collection. We have suffered from collecting our dues, but this has really improved. giving us a profit after tax of 9. Linked to chargeability and debt collection, these have been drivers. And risk management. It's an area where risk management, compliance, and the associated challenges in that sector still prevails. And we need to meet that minimum benchmark and then grow business from that base. So the growth will be business structuring, some private client services, I would say special licenses, very targeted. Instead of being broad, we will explore solutions in that direction. Expertise in cross-border investment and trading. It's something that is common in Mauritius, so we want to build that expertise. Client services in Africa and Middle East. And finally, hopefully develop partnership or structures in other international financial centers. So beyond the business being originated in Mauritius, can we originate business through other financial centers, but certainly through partnerships and other service providers not present in Mauritius. So across the board, a good set of results, and hopefully the next 6 months will be the same, if not better. Thank you very much. Oh, this is the last slide.
That's for.
Yeah. It's not working. So I'll just wrap up. It cuts across the board. Innovation and digitalization. Still looking for that across the board. Banks primarily. Investments, again, technology led. We absolutely believe that this is where it lies. Partnerships, existing partnerships across the shareholders that we have and beyond is where we want to go. Beyond doing business and finding those two top buckets, which is innovation and investment. Regulation is evolving, I think getting tighter. So we need to be alert to that. We're not just focus on the domestic market. So regulation was subject to other regulations as well. So we need to be mindful of that. And risk management as well. Primary operational risk, credit risk in the two banks. So the outlook broadly positive as we have a tight grip on regulation and risk, but most certainly looking forward to new investments, also in the technological space. AI is the buzz at the moment, and all these developments, we should be alert to that. That concludes it for CIEL Finance, and I thank you for your attention. I'll take questions as we come. Thank you.
John. So just a few words on the outlook as we're moving forward. So obviously we want to leverage on our position in East Africa, Madagascar, East Africa, but also India, where we are very much present today to drive growth and new growth drivers. So we'll do that by focusing on continuous improvement in operational efficiency. We have this operational efficiencies potential. So we want to remain focused on that, important part of our strategy. The second element is our that machinery and buildings to have our growth in India. So from an organic growth, so there's good potential on that front. Leverage on the portfolio of our hotel and resorts to unlock value from a yielding perspective. Sun Life today is healthy or healthier, and there's a good yields coming through, and we want to remain focused on yielding that portfolio. Maximize the regeneration of our non-core asset on the property cluster, being Fene and Evolis. Capitalize on the agro cluster with our African strategies, but also the property in Mauritius with Anaita. But then, most importantly for us is really to activate the new growth drivers we believe that we can broaden our manufacturing capabilities across India. They will employ 10,000 people. We have maybe 7 factories in India. So we have a strong know-how on the manufacturing front. Although textile is going to be organic, we think that we can explore other opportunities in manufacturing, and we are working on that in India. As Lakshman mentioned, generate innovative revenue stream to digitalize product and fintech collaboration on the base of the banking know-how that we have. So strategy for us is clear. So we know where we are going. Very clear, been discussed, approved by the board. So that's led to the recruitment of Mark van Binnegen, who will be joining us as in charge of the strategy and the investment. And really the idea behind this is to make sure that we are focused on our strategy, but also that we have the means, the resources to drive the new growth drivers, because these are in foreign countries, and with a very, very strong focus in driving these new growth drivers and that strategy. So that's for the outlook, and happy to take question. Yeah, we are happy to take question from now. Thank you very much.
Thank you.
See.
We'll shoot first. The usual culprits.
Start.
Je pense qu'on pourrait avoir concernant la regional séparation. Deuxième chose, plus parlons un peu de plus de headwinds. Donc avec l'introduction du salaire. Donc forcément ça va profitabilité, on va dire, est-ce que vous serez dans la capacité de quantifier cet impact justement sur la profitabilité, on va dire. Deuxième question. Troisième question, en janvier, on a eu quand même, il y a eu pas mal de concerns concernant les operators avec l'augmentation des passengers fees. Ils sont de 71%, je ne me trompe pas, l'année dernière, c'est en janvier. Avoir votre opinion dessus.
On détient un lease sur l'île OCF, okay? C'est un lease online que nous avons avec le gouvernement, mais nous avons aussi du freehold. Il faut savoir que là où est l'île OCF, c'est freehold à Saint. Donc l'idée, c'est de travailler sur un projet inclusif, une win-win situation avec la communauté. Donc c'est ce qu'on a présenté au gouvernement. Mais ce projet va nous permettre de régulariser les flux sur l'île OCF. Et donc, de mieux planifier les choses, qui va nous permettre, que je ne peux pas annoncer, c'est un cas confidentiel, mais d'arriver avec des projets qui ont du sens autour de l'écotourisme et qui vont vraiment nous permettre de positionner l'île OCF sur du long-term value, as opposed to something which is very difficult to manage today. Donc, there's a strong focus on that, and we believe that we can derive significant value from it, sachant qu'on a le Shangri-La qui est à côté. Et on a aussi le Four Seasons et l'île OCF et de milieu. Donc, pour le moment.
Et sur les coûts, oui, enfin, there is I mean, a full study done by management with the help of consultants actually to make sure that we catered and make sure that our employees were satisfied. Have risen on that front. Costs have risen on the electricity front. You mentioned the airport tax, and there's a number of cost elements coming into it. So the challenge for management is to be able to, really control that. And I must say we have an excellent team to do that. And the key is to be able to, protect our margin by grow them, by giving a better experience to the customer,
and making sure so that we can welcome different people from elsewhere in our staff as well, so that we can all improve together and provide a better service. So yes, it will have an impact, but we feel that management will be able to manage it. And the key is to give an extremely good service to the customer so that they can on keeping back, even if there is an improvement, if there is an improvement in the service. So the labor, I mean, the manpower cost to turnover is about, I think it's about 25%, which is compared to other countries. That answers your questions. Thank you. Any other questions?
Yes, I was wondering, Jean-Pierre, if you could elaborate a bit further on the issue that you had in textile, because I'm still trying to put the pieces together, because I understand there was an overstocking impact from COVID, but at the same time, I would have thought, as you alluded to, ASOS being an online retailer, that they should have benefited more, relatively speaking, during the COVID period than traditional retailers. So is it more that afterwards, when the traditional retailers came back online, people were substituting that again and were stocking less as ASOS? Or how do I need to think about that stock issue? Where have we reached today in terms of the inventory levels? And then more generally going forward, how do you think about that relatively positioning that you highlighted in terms of towards the likes of Hugo Boss and Lacoste versus more like those lower end retailers like ASOS and some of the others?
Well, the issues in textile, in fact, are quite difficult to solve, but being solved. ASOS was probably on the back of the success of the growth of ASOS internationally. We were led to depend a bit too much on them. And their order book, in fact, their sales dropped quite dramatically, as they as their own numbers have seen, and that has directly impacted us. So the impact on the total order book for Tropic Knits in the region has just been huge. So by the time it took to reconquer a new client has been quite long. And we also had some challenges on the manufacturing front in terms of operational excellence, which are now being tackled. And the good thing is that the pipe, especially so on the US market, is good. So we need to become essentially more competitive, get a better cost per unit in the region. And as far as India is concerned, where we have had difficulties for a number of years to really make India profitable. But we think that 3, 4, 5 years to come, especially so in India, because it's a huge market in India itself. We sell in India about 35% of what we manufacture in India. So it's a huge market, which is growing extremely fast, as you all know. And there it's been, I think the customer base hasn't been probably well tackled. And we are now moving more and more towards export markets. To lesser customers, getting the operational excellence at better level, and we're using our woven operational excellence across, the segment of activities to be able to help us grow that. So the impact is actually quite significant on the textile figures. But if you look at the woven business in India, I mean, the profitability is about similar to last year, and the business is very healthy. Now, the impact has really been on the region, which has suffered from this inventory. So we really think that there's a good momentum to capture as and when the orders come, but especially when the operational excellence is there. So there's a lot of potential ramp up as far as turnover is concerned with it. Investment of about 400 million recently in buying a new factory.
If I may add something, is that as well with the cost of money becoming more expensive, retailers who were chasing growth and market share are now focusing on operational efficiencies. So therefore, this has led to a general contraction of the level of stock across the board, which is a good thing because we see a lot of our clients with much healthier balance sheet, actually cash positive, especially in the US, which is going to be good when things are going to go back. But now, during this year, we've also seen a contraction. And the good thing for us is we are very strong with our customers. ASOS was didn't go well, but we have a good mix of customers and high-end customers like Ralph Lauren, Hugo Boss, and SpongeBob actually performing better on the market.
So I mean, what is interesting is we have in hand some big customers like Brooks Brothers, etc. And a number of the pipe is looking very quick a little while. Other questions? Yes, Stefan.
What is the value of your non-core property assets in Mauritius and over a medium term period? What are your main expectations from that asset base?
Yeah, so maybe let's say I'll start with Evolis. Evolis was sitting in the book of CIEL Textile because it was mainly except for that building. So today we have a net asset value of 1.5 billion. Okay, so which has been repositioned on the market. So that's value. We've raised the bonds against that, starting to yield. We generated about we'll be generating 150 million of EBITDA, whatsoever it is. So I think that's well set. So that's for Evolis. On Fernet, as you know, we have 3,200 hectares of land that we will unlock through our project of Smart City. But now what we actually unlocked about 550 million rupees of cash by selling. So obviously there's significant value to that. But what we are seeing is that the sale has generated a significant profit. So which means that the value that we have booked in our is, it's not overvalued as per market price. So we think that with Fernet Smart City, we will be generating sustained income as we go along. And then the reality is on Sun, because Sun we have about we must have about 40 acres of undeveloped land next to our hotels. So that's a rough numbers, and don't quote me on that, but it would be close to that with significant value because it's either freehold land close to the sea with access to the sea or leasehold land with long-term lease. So we think that we can generate significant value from that.
Second question about the discount to NAV, which is now close to 40%. Are you exploring in a way or another to
Yes,
corporate action or?
Well, we can't. I mean, we are concerned about this. I mean, we are there to create value for our shareholders, and even though this discount is somehow aligned to other conglomerates, not all of them. Some of them are in Packard is different, but generally for closed-ended fund, we're not far from what's the market. But yes, we are concerned with this, and we're certainly working on making sure that we bring down this discount. Might be long term, and it's not the forum to be able to disclose, but we are well aware and we are working on it.
Other questions?
Just had a quick one, maybe. You'd mentioned a lot about technology and how you want to bring that forward. I just wanted to understand maybe, if you could give us an update on POP, how that's doing on the market. Did I bring you new clients or just some color a bit on that, perhaps?
Yeah, good one. Since POP was The good thing is the growth has been there, so we are still having acquisition, not to our expectation, but still growing. What we are looking one is irrelevant because it's a switch to the Bank of Mauritius that supports POP. We have now switched it into more, how do we accompany merchants? So more the merchant side, more those adopting POP, potentially acquiring more retail clients that are not clients of ours, and hopefully developing other digital solutions to support these merchants in terms of their needs, be it on POP or outside of POP. So as we alert to the client needs, we have sort of shifted the trajectory of POP. The fact is the market is much more competitive than initially expected. As we have said, the pace of technology in the financial services sector is accelerating. We do not discount the fact that there might be other players coming to that space. It's finite at the end of the day with the population that we have. There's a bit of trajectory, but it's profitable. Not exceptional, but it's we compete against the credit cards. I go more on the merchant side.
Yeah.
We don't charge anything to the retail clients. There's no fees there. But typically, credit cards for payments will charge you anything up to 2.5%, 3%. We are on the range of 0.5% to 1.5%.
Okay.
And the competitors are about there as well. Some taking us heads on. That's it. So, yeah.
Thanks. And are there some synergies between this one and the one in Madagascar? Because I was also wondering, the more people are banking on mobiles and have a bank account, how does that work? And is there some knowledge transfer and technology transfer that you can do?
No, because POP is anchored on the national payment switch at the Bank of Mauritius.
Okay.
And there's no national payment switch in Madagascar. So there's no transfer there. However, we know that we are position if the national payment switch in Madagascar makes some progress. You're right, for now, mobile, it's easy. You need just a cell phone and access to mobile operators. And the wallet is created. So between Telma and Orange, it's massive. Actually, they have more clients than all the banks aggregated. It says a lot. It's just access for payments. It's not about keeping credit balance. It's about making payments. So that remains in many markets a disruptor to banks. But you should look at the economy and how it supports the economy. So how do we service the telcos becomes the proposition for the banks. But the national payment switch will make a big difference in this lens. And then the experience from Bank One might contribute to that.
Yeah. One other question quickly on the local banking landscape, if I may. So that deal that's happening between HSBC and ABSA on the retail banking side, banks and wealth, is that going to be an opportunity, a threat, or Bank One doesn't impact?
Is that a threat? I think generally speaking, speaking of banking sector in Mauritius, I think there's the bank in Mauritius has a retail segment. I believe this is one of the reasons why HSBC exited Mauritius, because in light of their risk appetite and their trajectory, they couldn't grow more. And therefore, they felt they should exit that, but they retained where they saw the growth potential. So international and domestic corporates was retained, but the retail side was sold. Is it a threat? It is always a threat. Any retail bank will be a threat to our retail segment. One. So how do they aggregate and put new solutions out? Remains to be seen. ABSA being well established and the MCB and State Bank being the largest retail bank, I think they will maintain their position. Do they take clients from Bangkok? Maybe, maybe not. I think they are just consolidating their retail market share. This is what it brings to them. Notwithstanding, we understand as well.
Just one word
Yes.
before we finish. I just wanted to inform all those present and all those online that there's an independent research. I think it was 2 days ago. So through the investor relation department of CIEL, you will be made informed of the link that you can access this report. Well, they valued
20% upside.
Yeah. 13 rupees, they use a discount, and they said the average price around 10.50. That's why the independent opinion on the price. But we'll make it accessible for all of you.
It's an independent report. Okay, good. So, I mean, for me, it's my last analyst meeting. So I really wanted to tell you a couple of things. I mean, the first thing is that CIEL is in very good shape. And CIEL in very good hands with, of course, the team which is present here, with Jérôme, Lakshman, and Guillaume, who's taking the leadership. We are delighted that Mark is joining the team. I think it's going to be a great input. And we look with a lot of excitement. I mean, soon I'll be saying that at a level of but also potentially expanding the sectors in which we are in, as Guillaume mentioned. I think is going to be an exciting avenue. So I really wanted to thank you. I mean, I've seen many of you for so many years, and it's a thank you for your support, for following up CIEL and being present all along us in our history. And I think it's been great working together. So a big thank you to you. A big thank you to the team who has worked on this presentation, preparing the results. It's really a pleasure to work together in such good shape and good harmony. We know that things are driven very well. I can assure you of that. So thank you very much. Some